There is one market signal that has warned of almost every American recession for the past half-century, and most stock investors barely glance at it. It does not live in the stock market at all. It lives in the bond market, in the quiet relationship between short-term and long-term interest rates. When that relationship flips upside down, the bond market is effectively saying it expects the economy to weaken. It has been right before nearly every modern downturn. Yet while stocks were busy making new highs, this same signal spent the better part of 2 years flashing the opposite warning. This is the story of what the bond market keeps trying to tell you, and why so many people miss it. Here is the core idea up front. The shape of the yield curve is just a picture of interest rates across time, from 3-month bills all the way out to 30-year bonds. Normally, longer loans pay more because lending for longer carries more risk, so the curve slopes gently upward. But sometimes short-term yields climb above long-term yields and the curve inverts. That inversion is not random noise. It is the collective bet of millions of bond investors that the central bank will be forced to cut rates in the future, which usually means they expect the economy to slow. You do not have to trade a single bond to read this. The slope itself is the message. And understanding what that message has meant in the past is the whole point of this video. Step back to how a bond yield is actually set. When you buy a 2-year treasury, you are locking in a yield today for the next 2 years. When you buy a 10-year, you are locking in for a full decade. The 2-year is driven mostly by where investors think the Federal Reserve will set short-term rates over the next couple of years. The 10-year reflects expectations for the whole decade ahead, plus a cushion for uncertainty. In normal times, investors demand a little extra to lend for longer, and so the curve slopes upward. That is the resting state of a healthy market. So the natural question, the one that opens up everything that follows, is this: what would have to be true about the future for investors to willingly accept a lower yield on a 10-year loan than on a 2-year loan? The answer is the heart of the whole signal. A long-term yield can be thought of as 2 pieces added together. The first piece is the market's average expectation for short-term rates over the life of the bond. The second piece is the term premium, the extra compensation investors want for the risk of holding a long bond through years of uncertainty. Now watch what an inversion actually requires. If the 10-year yield sits below the 2-year yield, investors must be expecting short-term rates to fall, and to fall enough to drag the long-run average down below today's short rate. In plain language, the bond market is pricing in future rate cuts. And the Federal Reserve, historically, cuts rates aggressively for one main reason: to rescue an economy that is slowing down. So an inverted curve is really the bond market saying, we believe the Fed will be forced to ease because we believe growth is heading lower. That is the quant wedge at the center of this whole idea. The curve is not predicting a recession by magic. It is aggregating the rate expectations of the largest, deepest, most informed market on Earth. And those expectations quietly encode a forecast for the economy. This is why the curve has built such a striking track record, because bond investors are forced to take a view on the path of the economy years into the future. The slope of the curve has inverted before nearly every American recession since the 1960s. The lead time is long and variable, often somewhere between roughly 10 and 20 months from the inversion to the actual downturn, which is exactly why it works as a slow warning rather than an instant trigger. Stocks tend to look right past it, because the stock market is built to price the next few quarters of earnings, not the slow turn of the credit cycle. So you can get the strange picture of equities making fresh highs while the bond market is quietly signaling caution. They are not actually contradicting each other. They are measuring different horizons. The curve is staring years down the road. Stocks are looking just over the next hill. But here is where honesty matters, and where the bond market just delivered its most famous false alarm. Starting in the summer of 2022, the curve inverted, and then it stayed inverted for 784 days, from early July 2022 until late August 2024. That is the longest inversion in recorded history, beating the previous record of about 624 days set back in the late 1970s. By the textbook, a recession should have followed. Instead, the American economy simply kept growing. Unemployment stayed low, and the downturn the curve seemed to promise never arrived on schedule. When the curve finally turned positive again at the very end of September 2024, it did so without the recession that had usually come with it. That does not erase a half-century of history, but it is a real and important reminder that this indicator measures expectations, and expectations, even those of the bond market, can be wrong. So what do you actually take from all of this? Not a prediction, and certainly not a trade. The lesson is that the bond market and the stock market are answering two different questions, and listening to both gives you a fuller picture than either one alone. The yield curve is a lens for the market's collective expectation about the future path of growth and interest rates. When it inverts, it is worth asking why so many investors are betting that rate cuts are coming. When it is steep and upward sloping, the bond market is leaning the other way, toward growth. It is a gauge of expectations, not a guarantee of outcomes, and the last few years proved that it can be early or even simply wrong. The forward question is a simple one. The next time stocks and bonds seem to disagree, ask which horizon you are actually trading and which one the bond market is watching that you are not. If breakdowns of the market's hidden machinery are useful to you, there are more of them here. This channel explains how markets work. It is educational, and it is not financial advice.